Financial markets. To some, they suck because of the financial crisis back in '08. But what is it? This is a market in which people trade financial securities and derivatives at low transaction costs. Basically, they are structures through which funds flow. These financial markets contain financial instruments or securities, which are assets that can be traded. These assets include cash, ownership of an entity, or the right to deliver or receive cash. There are various types of financial markets that are going to be covered in both this video and its part 2. Now let's begin with the basics. Primary markets. Primary markets are markets where corporations raise funds by issuing new securities such as stocks and bonds. A major difficulty for these businesses is that they don't generate enough revenue by themselves to pursue new projects or expand their current operations. To rectify this, they issue primary market securities with the help of an investment bank to sell them to investors. The first public issue of these securities by a company is referred to as an initial public offering. Anyways, once these securities are issued, they are traded in secondary markets. Secondary markets are markets that trade financial instruments once they are issued, where the buyers of these instruments are consumers, businesses, and governments with excess funds. The sellers of these secondary market securities are in need of funds, so this is a great fit. When these securities are bought in a secondary market, funds are usually exchanged with the assistance of a securities broker. Two decent examples of secondary markets are the New York Stock Exchange and the Nasdaq. Secondary markets also trade foreign exchange, derivatives, and financial instruments backed by mortgages and other assets. In addition, there are a multitude of advantages to investors and businesses who participate in secondary markets. Secondary markets allow investors to trade securities quickly and purchase securities with a wide range of risks and returns on their investment. And the businesses are provided with information on the market values of their securities, which can help them to judge how well the funds generated from the securities are being used. A further benefit is that the centralization of these markets, as well as the speed and efficiency of their transactions, can save these buyers and sellers time and money in trying to find each other on their own. And one last icing on the cake is that secondary markets are pretty liquid, as in they can easily turn assets into cash. Next up is money markets. Money markets are markets that trade debt securities or instruments with maturities of 1 year or less. By the way, maturity is the date of the final payment due on a loan or other financial instruments, so securities in money markets need to be paid within a year or less. Hence, in money markets, it would make sense for people who have short-term excess supplies of funds to trade with people who have short-term needs for funds. Due to this short-term trading, price fluctuations for money market securities are quite small in secondary markets. Most American money markets are over-the-counter markets, which are markets that do not operate in a specific fixed location. Essentially, these transactions can happen over telephones, wire transfers, and computer trading. There are various types of securities that flow through money markets, and these are the following. Treasury bills. These are short-term obligations issued by the US government. When they are issued, an investor buys them, which provides a loan to the government. Federal funds. Short-term funds transferred between financial institutions like commercial banks, usually for no more than 1 day. Repurchase agreements. These agreements involve the sale of securities by one party to another, with a promise by the seller to repurchase the same securities from the buyer at a specified date and price. So you buy the security from a seller and resell it to the same buyer at a later date. Commercial paper. They're short-term unsecured promissory notes issued by a company to raise short-term cash. Promissory notes are just unconditional promises to pay back the borrowed amount. It is usually used by companies to meet short-term obligations. Negotiable certificates of deposit. Bank-issued time deposits that specify an interest rate and maturity date and are negotiable, such as being able to sell these deposits to another party. And last but not least, bankers' acceptances. They are time drafts payable to a seller of goods with payment guaranteed by a bank. In other words, this represents a promise by a bank to make a future payment. My part 2 video will cover capital markets, foreign exchange markets, and derivative markets, and will hopefully come out in 2 weeks. Anyways, I hope you enjoyed this video. If you did, please give a like and comment, as it really helps my video in the YouTube algorithm. And if you like economics and political commentary, consider subscribing. Maybe follow me on my Twitter, and see you later.